Service industrial is a unique niche subsector of traditional industrial. Some of the key features that we look at when we define service industrial is it's a smaller bay product. So we're looking at average suite sizes below 10,000 square feet. Typically you have more grade level loading than dock high loading. It's okay if there is some dock high loading, but and candidly, dock high loading in a space less than 10,000 square feet is a rarity, so it's actually a positive. But mostly we're getting uses like contractors, landscapers, plumbers, electricians. So they're not driving big tractor trailers. It's predominantly pickup trucks, box trucks, vans. They come to the product. This is where they store their goods that they eventually go take out to the community to provide the service. Maybe they're doing some manufacturing. Some of the suites do have significant equipment bolted down where they're working on metal or wood and actually making things. So one of the things that's interesting about service industrial is the variety of tenants. It's really, I like to call it a Swiss Army knife of real estate. You have all of these, service type uses that I've described, but you might also get, some retail uses. Maybe there's the batting cage, the dance studio. So it's really flexible in terms of providing a workspace, and it tends to be, shallower bay, like I said, as well. So, 120 feet deep, lower office finish. So we do want to distinguish it from, flex/business park. So we like 40% office or less. So those are some of the things we really focus on for service industrial. Also clear heights. So we're typically in that as low as 12 to as high as 24. But again, a lot of our sweet spot really gets up to about 18-foot clear heights. It's not meant for racking and significant distribution. It's really a place to provide a service to the community. So when we're looking at service industrial, we have a very detailed scorecard, and it enables us to focus in on the features that we like. So all those physical features that I mentioned. And then also, we're doing this in our value add fund. So how do we create value? So we're looking at the weighted average lease term of the tenancy. So we want short WALT, so we can get in there and push rents. And so if we're going to push rents, we want a significant spread between the current market rents that are in place versus what we can achieve in the market, bringing in new tenants, et cetera. So that's how we really look at both the physical, some of the features. The scorecard in our process is incredibly helpful, as we can go out there and proactively identify the assets that we want to buy. And even the submarkets, we're really looking at population density, strong demographics. This becomes mission critical space for these tenants to then service that community. So it's hard for them to move, and they're also not building any more of it because it's smaller. It becomes really expensive to demise it down. You have a bathroom in every small suite. All of those drive the costs up, and they're more infill locations. So they're just as you can see, a smaller physical footprint. So in terms of development, you're not really deploying a lot of capital efficiently. So we find that developers tend to focus more on ways they can deploy capital in the new shiny Class A distribution space instead. So we love that you've got this diverse pool of demand. It's really mission critical space for them, and there's lack of supply, and there's actually shrinking supply. When you look around, you'll see some product that used to be this service industrial. It's gotten demolished and replaced with luxury townhomes or brand new Class A last mile distribution centers. There's usually a higher and better use for this space. So we really like having that pricing power as an owner, and providing improvements to the community so that it can service these users. So now that you have a better sense of what service industrial is, Victoria, why don't you talk about our acquisition in Houston, some of the features, the business plan, how we sourced it, and we've owned it for over a year now, so maybe talk about some of the metrics that you're seeing.
Yeah, so Gateway Industrial Commons was a large portfolio that we acquired in the northwest pocket of Houston. This was owned by an unsophisticated owner, aggregated the portfolio over 30 years, so there was a lot of meat left on the bone. They hadn't really pushed rents. We came in and purchased the 9 properties, totaled nearly 630,000 square feet across 46 buildings, over 150 plus tenants. It was a lot of moving pieces initially. The mark to market at the time was about 70%, so there was a lot of initial wood to chop. But the asset, now that we've owned it a year, we've implemented a lot of our 90-day blitz capital items, as we call it, which includes, updating the exterior paint, making sure that we repair the asphalt and the concrete, restriping, even adding on this particular property, we have energized gates, things like that, just to create more of that community feel for the tenants that we're servicing here.
So 630,000 square feet, that's a pretty big portfolio. Is that typical for service industrial and the sort of investment strategy we have?
Definitely not. A lot of these are owned by one-off mom and pop owners, so you're really not going to usually find this much scale. So this was kind of a diamond in the rough.
But in terms of the mark to market, I mean, that's a pretty consistent theme that you're seeing from these private owners. How do we get to the point where rents are so far below market?
Yeah, a lot of times these owners have owned it for so long, they have it unencumbered by debt, they don't really have a need to push rents, they just kind of maintain it for cash flow. So that provides us the opportunity to come in and look, we're going to push rents to what market is and also implement a decent capital improvement program.
So, we execute our value add plan. What are sort of the metrics? Like, by what period of time are we getting to what yield on cost, and how does that compare on a risk-adjusted basis to other opportunities you may see?
Yeah, so on this particular asset, given that it was so far below market, we were going in, just shy of a 5 cap rate. We think by year 3 we'll be able to accomplish north of an 8.5 yield on cost. And again, that was with short walled, a significant mark to market. So year to date, since we've owned it a little bit over a year, we've been able to achieve slightly above our pro forma, closer to, call it almost an 80% mark to market. And we've gotten through, nearly 70 leases, again, 150 plus tenants. So it was a lot of upfront work. We acquired this at a significantly low basis compared to replacement costs. There's also significant underlying land value given the locations in infill, Northwest Houston. A lot of the adjacent properties, as Jeff mentioned, get torn down for higher and better uses sometimes, new luxury townhomes that can be 500,000 almost.
Yeah, so for our strategy, again, we're looking at value creation and really trying to get to that 8 yield on cost by year 3. So some of the things we're looking at is obviously the amount of mark to market, how short the WALT is, but there's a few different ways to get there. Mm-hmm. There's the heavier value add like this that needed cosmetic improvements. There's a pretty significant CapEx plan. The WALT was less than 1 year, so as you mentioned, a lot of wood to chop. Lower cap rate going in, but you get to a much higher yield on cost at the end of the day. There are other opportunities we see where maybe that mark to market isn't as high, maybe it's more like 30%, but you're able to buy it closer to a 7 cap,
right,
and still achieve the same metric of getting to that 8 yield on cost, just starting from a higher cap rate.
Right.
Interesting. Look, this is one of our highest conviction strategies right now, service industrial. In 2024, it was really the only investment we made as we still navigated that bid-ask gap, during the uncertainty of pricing in a lot of the other sectors that were battling some supply headwinds, et cetera. This sector does not have a lot of supply, has a ton of demand that's kind of consistent through various points in the cycle, and we're buying from owners, as Victoria mentioned, that aren't driven by what's going on necessarily in the market. They've owned these things for a long time, great basis, tons of cash flow. They're just driven by life events, death, divorce, retirement, don't want to manage these things anymore. So it's been really fruitful for us to identify these assets proactively, reaching out to these owners. And again, it's one of our highest conviction sectors, and over the last 5 quarters, we've acquired 1.3 million square feet of it and expect to do a lot more here in 2025.